welcome to the Market Standard with myself, Dineo Zamela, and Simon. I hope everybody is well and into 165 days of lockdown. Before Simon joins me, I just want to make sure that everyone can hear me. So if you can hear me, could you please lift your digital hand? It'll be the hand icon next to your name. Okay, I see a few hands. Simon, hello. Welcome to day 165 of lockdown.
Morning, Dineo, and day something of spring. Last week, spring was very weak. This week, it's proper. As I was saying, I had just a T-shirt on earlier. I mean, I wasn't silly. I went to put a jersey on because I'm from Durban, but I could have done it.
And it's nice. It's pleasant. It's getting it is getting a bit hot at night as well. I'm finding I could just be sick.
Don't say that.
But yeah, very, very much looking forward to the summer months and hopefully being allowed to be free outside and enjoy the summer, much like the Europeans have done. So this week, obviously, we're going to kick off looking at what's happening with the US. We've seen unemployment really coming down, now at 8.4%, and lots of temporary jobs, 238,000. Yes. And, that's quite a sizable portion of August gains.
Yeah, I don't know. You're right. 238,000, and that's just into the census work. And that's about 15% of the total of 1.4 million jobs that are gained. But at this point in a crisis, the key point around jobs is that they help get money into people's hands, and first and foremost, so those people can feed themselves, then pay school fees, pay rent, etc. Get some money moving in the economy. So we were always going to see this blip coming at this point, and so this rise in this point in the process. I got to say, an 8.4%, even the temporary jobs, they are what they are. I mean, we take the stats and we work with them. They will work their way out of the system in the next month or two. 8.4%, that's a really good number. I mean, we've been commenting that they were stuck, that the weekly jobless claims were stuck at north of 1 million. They've only twice since the crisis started back in March managed to get under 1 million claims. But the broad sort of unemployment, and we've spoken before that there's some statistical oddities in this data in terms of people who are temporarily off work. That would usually mean, jury duty or maternity leave or holiday or something. And obviously under the pandemic, that might mean, well, temporarily off work, but maybe never coming back. But that would push the number higher, but it would still have the trend as the same. And that's what's really fundamental here, is that trend having peaked at over 14% unemployment, which was a record. If I go back to this data here, only goes back to the sort of early 50s. It had spiked at an absolute all-time high. And, now we are back below the worst of the 08-09 crisis. We are back below the crisis of the early 80s, which was the oil crisis in the US. When we tend to forget that when Reagan came into power in January of 1981, the US had interest rates of in the teens. They had inflation, at around 15%, and unemployment at around 10%, which it seems crazy, but there it was. So short answer, unemployment improving. This is good. We still haven't had any extra relief packages from Congress. I think they might look at this and think, well, we don't really need to. I'm not sure. 8.4 is still a giant number, but I was not convinced that they were going to get back below 10% easily. Short answer, they have. The U.S. economy is pumping and firing, and considering, if you had said to me a year ago that we would have a pandemic, the first in a century, and that second quarter GDP quarter on quarter would all be around the minus 10% for the sort of G7 nations, that we would have hard lockdown extending for around about 10 weeks in much of the world. And you told me that by September, U.S. markets would be at highs and unemployment at 8.4. I think, frankly, anybody would have taken this. That this is definitely the high road compared to what I think we would have expected from a pandemic.
Yeah, definitely. And I think, to your point about the surprise or the really quick recovery is, how do we sustain that momentum? And again, we've pointed this out that, it's going to be probably quick, but it's going to taper out eventually. So I think over the next couple of weeks, we're definitely going to keep looking at this number and seeing how the rate at which it slows down.
Yeah, and to your point, we will monitor this because even if there are oddities in it, it does mean. I mean, we almost hit a 16% unemployment rate. Let's round the numbers. Unemployment has halved. That means a significant portion of Americans are again getting paychecks. We can debate the nuances. That's critically important. And of course, this is America. It's not South Africa. It's not Western Europe. But America is the world's largest economy. If we throw China into that equation, we're at about 40% of the global economy. So at least the economy is the global economy is more coming right than not. Emerging markets, ourselves included, are way behind. And I think when the dust has settled on this, and we're talking 2025, and economists and sociologists and anthropologists look back at this period, I think one thing we are going to see is very much we talked about, was it a W or a V or a U or an L-shaped recovery? In truth, it's a K-shaped recovery. We see it within markets where we've got tech stocks flying and the rest under pressure, the lower leg. But we're also seeing it in the global economy, where the developed economies, which had stronger balance sheets, so to speak, Western Europe, North America, China, sort of the top leg, Eastern Europe, Asia, Africa, South America, the bottom leg of that K. That has longer term implications, but as I said, that will be something which I think we'll look into a lot more. The experts will, once this dust has settled.
Definitely. And then, last week we obviously had a very good rally up until Thursday in US markets. And then there was a massive, massive sell off. Tech stocks really taking a knocking. Friday was just like all red, but not quite as shocking or as hectic as Thursday. The tech stocks were very hard hit. What happened, Simon? I mean, nothing seemed to indicate any particular, no one can seem to pinpoint a solid explanation for why we had the sell-off. It was the general consensus seemed to be, profit taking. Investors were just like, oops, highs, let's just take profits and get out.
Yeah, it is weird. I mean, Thursday was, one of the worst days of the year. I mean, I woke up Friday morning and saw the Nasdaq down over 5%. And much like you, my thought was, what the heck happened here? And lots of little bits and pieces, but no, last time the Nasdaq was off 5% in a night, which was obviously just earlier this year. Yeah, there were lockdowns, there were pandemics, there were, now we still have lockdowns of a sort. We still have a pandemic raging around planet Earth, but we're kind of getting to that point of learning to live with it. And I think it was very much just a good old-fashioned, route of some panic selling. It followed into Friday. Friday was looking really, really ugly. The Nasdaq traded below 11,000, but then recovered, markedly recovered. Rallied almost 400 points off the lows. Still closed down. Still closed, more than 1% weak on the day. And ultimately closed the week red, which is the first time in I think since April that we actually had a red week on the Nasdaq. But no particular point we can point to. Make no mistake, you mentioned the 2 points of high valuations. This market, and by this market I'm talking S&P, I'm talking Nasdaq, and obviously particularly tech stocks, is expensive. It is very expensive by any metric you use. Now, it is pricing in the return of, coming back. We will start to see spending happening and picking up all of that, etc. But it is still crazy expensive. If we take, for example, Apple, and we take the 2019 earnings, i.e., pre-COVID, Apple's trading on an almost 40 times PE, which is, for Apple. I mean, they're an amazing company. They print money, but their growth is slowing, and they're not pricing that in. Apple just 4 or 5 years ago was trading on a low double digit, at sort of 12, maybe a 13 PE. We've got Amazon back at crazy PEs. This market needs to, one of three things happen at high valuations. Either the earnings catch up, or the prices come down, or the combination happens and prices go sideways as it waits on earnings. And it can be a combination of all three. But the US market, the tech sector, has got way, way ahead of earnings. Even if we, are generous and say that they can do, those big stocks can do, 30 to 40%, which certainly they have been. So it's not impossible. I also note, so the US is closed today, Monday. It's Labor Day in the US, so no trading in America or Canada. But the Nasdaq futures are red again this morning, about 1% down. S&P a little bit green, and Dow Jones a little bit red. But, that market is more than 24 hours, about 30 hours away from opening. So I wouldn't hold too much stead by that right now. But as things stand right now, it did just look like it was a massively aggressive sell-off, bit of panic, and then largely people were back to, oh, yeah, no, we must own this. And, let's not get shaken out. Let's go buy the shares.
I think, Simon, what would be interesting to start observing or sort of keeping track of is, whether that these sell-offs are triggered by institutional investors or retail investors, or a combination of both. I definitely think there's been certainly like a massive influx of retail investors that are, while not massively, are really starting to their movements start to impact quite a bit the movement of the markets. So I think that's certainly a trend that we'll need to start keeping track of, to just see how much the collective power of retail investors is factoring into these inexplicable, for lack of a better word, sell-offs, where people are just like, maybe this is as high as it's going to go. Let's just take profits and come in slightly lower and push the envelope a bit, or push the levels a bit higher and higher. Who knows?
Yeah, I take your point on that. And, investors are only ever the froth in the market, or REIT private clients, me, you, and the listeners here today. But truthfully, they matter because they are the froth in the equation. I think it was you retweeted a great thread this morning on Twitter around also the process of options, and the whole options have almost become the new gambling in a sense. And particularly a lot of the options in the US being traded are short dated, couple of weeks, maybe a month at the most. And essentially what then is rolling in that. The example in the thread this morning, a $1,500 option premium results in some poor market maker buying $60,000 to $80,000 of equity. And then, of course, as that rolls and expires, that then comes selling. The other interesting point around retail clients, and they might just be the froth, but that froth is not unimportant. And there's a key distinction between how me and you would invest as opposed to an institution. Institution, when they exit a position in the market, they have to find a new home for that money. They can't sit on cash because it earns nothing, and they're going to lag their benchmark. They're going to get destroyed. So, they're not keen sellers, they're keen buyers. A retail client, it's not many retail clients will exit one and move into another. But make no mistake. I mean, I have a friend in Boston. He made some money on, I think it was Kodak or Hertz or one of those bankrupt stocks. And he made himself, I don't forget what, call it $10,000. And he took that money out and paid off the remainder of his student loan. So as a retail investor, the money doesn't need to go back into the market. It often does. But there is something else that we can do with it: a holiday, a loan, a car, upgrade your house, whatever. That froth that sits at the top, which is the retail investor, can disappear. It absolutely can for periods of time to degrees. So, it might be small, but it's not insignificant.
Yep. And it will, those 1-2% moves are not, you can't ignore them. So, I think we're entering a new phase of really understanding what moves and drives market dynamics, and it should be very fascinating.
Yep, indeed.
And then looking now, And perhaps let's touch on Tesla, and then we'll go into the rest of the world. But so after much hoorah and anticipation, Tesla did not make it into the S&P 500, and there was quite a massive sell-off. Also, included in last week's sell-off in the stock following the stock split, which we spoke about last week. So here, Simon, you've got the quote: in order to get into the S&P 500, companies must be US-based and listed on either the New York Stock Exchange, the Nasdaq, or the Cboe. They must also have a market cap of more than $8.2 billion US, and report 4 straight quarters of profit as determined by the US Generally Accepted Accounting Principles, or GAAP. And Tesla did not meet those requirements.
Well, here's the weird thing, Tesla did. But, in South Africa, when indexes are rebalanced, the JSE is for changing our index 21 September, which is 2 weeks' time. Harmony goes into top 40 and RMB comes out. The indices that we see in South Africa are completely rules-based, set of rules, and so they happen. We spoke a few weeks ago about the Dow Jones and how it's almost in a sense arbitrary. And truthfully, so is the S&P 500. You have to meet certain criteria. Tesla met it, but they put Etsy in instead. And that's just the committee deciding that, I don't know, that they want Etsy instead of Tesla. I mean, maybe there's a little more to it than that, but certainly there is a sense of it. It's not the level of rules-based which we are certainly accustomed to in South Africa. Tesla in of itself, just a little while ago, it was split adjusted $300. It hit $500 last week after the 5-to-1 split, and on expectation that it would go into the S&P 500. And of course, that would then see vast amount of index trackers having to buy it. It didn't, and it then started to come back to us. So having hit 502 and some change, it then closed the week at just under 420. I think the low for the week was just under, was under 400, around $370 odd dollars. So massively coming back to earth. Still a crazily expensive stock. My price here is not showing me a PE. Well, there we go. I mean, earnings per share of 40 cents a share. They're approximately a PE of about 100 and some change. That is insane. And I get the story, but we're not here to debate Tesla in of itself. Yes, EV, electric vehicles, is the future. Will it be Tesla? Well, certainly they're one of the leaders in the space. But the valuations, I was chatting with Viv Govender a few weeks ago, and he was saying you actually have to value Tesla as a tech stock and rather look at it at autonomous driving as distinct from what they have right now, which is just EVs. And in that sense, I suppose it makes a little more sense in the equation, but it's a long way away. So, part of the sell-off that managed a green Friday was just, I think, the hype and excitement. The stock split happened. It had rallied, 20-25% from the beginning of the week to its highs. I think a lot of folks were starting to say, yowza. The range on the stock, the 52-week range, is $44 to $502. Its 1 year change is 820%. If you bought this stock at any point before August, you have made, bucket loads of money. And I think it was just a lot of that froth coming off, not getting into the index. Split has happened and peeps have taken some profit. I would not be the one out there to say it's time to be shorting it. I'm certainly not brave enough for that. At some point, this will be one of the, epic shorts, or Elon Musk will pull it together. Can he? Time will tell. There's my PE. 1,000. Sorry, my bad. My math is not that good. Can Elon Musk do it? Time will tell. But this is now, a $500 billion odd company. That is a lot of money for a company that only produces 500,000 cars a year.
Yeah, definitely. And we've had the debate about the fundamentals of Tesla, but again, we have put it on the long-term watch list just to see if eventually there is some convergence between what the share price says and what is actually happening with the fundamentals.
Yeah.
So that's going to be.
And my analogy would be Amazon. And I remember, I remember Amazon in the dot-com boom and the subsequent collapse. I remember Amazon when it went into the S&P about 2006, and everyone was saying, and at that point Amazon was probably its PE was probably a couple of 200-300 times. I remember the days when Amazon wasn't, they were making literally a couple of cents every quarter, and on a crazy share price, and some companies absolutely grow into it. Locally, I remember Capitec on a PE of 150, and back then the share price was $70-$100, and it seemed crazy. Now the share price is 800 and the PE's around 20. A lot of companies can grow into their PEs. Of course, not all of them do. That is not certain. And Tesla certainly might grow into its PE. It's not certain, but it can.
It's a possibility.
It's possible.
And then now moving into international waters. So tensions between India and China heating up with all sorts of interesting and scary border wars, and India placing an app sanction. This is the new age of sanctions where they're no longer economic, but they're technological. 118 apps banned by India, Chinese apps. And I think, Simon, it's very interesting because this sort of move to impact economic trade or trade balances through technological access is going to be quite an important and prominent feature, I'd imagine, going forward.
Yeah, you're 100% right. Back in the olden days, when you had tensions with your neighbor, you had war. You just had a war instead, and truthfully, that didn't resolve much. You just had war after war, but that was how you did it. Then we sort of brought economic, and it's what Trump is doing in the US, where you tariffs or sanctions, even perhaps as far as and sort of economic warfare. And now what we're seeing is as you say, it's digital, it's technological. And the reason I wanted to bring up the India one is because, obviously we know what Trump in the US and China and what's happening there. And that has definitely moved beyond tariffs, the ban on Huawei 5G equipment, the forced sale of TikTok, although China's now added the IP within TikTok into a list of Chinese goods that can't be sold without permission from the Chinese government, so that gets complicated. But we kind of like the India-China. India-China has actually been having some border skirmishes. I don't want to call them warfare because they're not. They're border skirmishes across. They have a border and a couple of thousand miles in length, Himalayan mountains, and there certainly has been some skirmishes happening there. And India, about 6 or so weeks ago, banned a whole lot of Chinese apps, including WeChat, and now they've upped the ante and banned a whole lot more. A lot of these that are being banned are, for example, WeChat derivatives and the like, so it's just sort of, it's not so much new ones, but a bunch of them is new apps as well. WeChat in India is popular for communications and the like, but the biggest remains WhatsApp, as it is in South Africa, and then the Facebook Messenger. But it does show that there are significant tensions between the two. India obviously is an important, although not a G7 economic powerhouse, but between the two countries, they're probably approaching 3 billion people. That's about 35-40% of the world's population, and I think it's something that can't just be ignored. Those tensions are significant. China, the second biggest economy, India, an important global economy, both with 1 billion plus people, and they're not going away. It also plays to, and we've spoken about this early in lockdown, I don't know if you remember when, and we're probably going back to April, maybe May, where Japan was basically paying some of their Japanese companies to bring production back from China, to say, look, you produce that widget in China, we've got some money, and I think it was $100 billion they had. We will help you to set up production in Japan. And that wasn't so much because Japan wanted the employment, which they do, but again, it was concerns around China. And this is China flexing its geopolitical muscle. This is China and its Belt and Way initiative, particularly into Africa and to a degree into Asia and sort of Cambodia, Vietnam, sort of neighboring economies, etc. There is a lot of what's what I'm looking for? A lot of uncertainty around China flexing its muscle, which China is absolutely wanting to do. China's looking at being the next superpower after the US, and they're actually butting heads more than just with Trump. They've got it with India. They've got it with Japan. They're happy to do it and to flex their muscle in a sense.
Yep, and I suppose you don't become a world superpower without sort of exercising a bit of economic muscle. So I think with India and China going head to head and really trying to take up that space in the global economy, I imagine over the next couple of years those border wars or skirmishes will most likely intensify.
And there would be probably between the US and China if they shared a border. They don't. So it's moot. Although there is, of course, the South China Sea and Taiwan, where I suppose it'll play out as proxy in a sense.
Yep, definitely. And then lastly, Carnival corporations, they're going to be kicking or opening back up and cruising. Departing from Italy this coming weekend. So we're seeing slowly but surely, the travel industry opening up, rather cautiously, but certainly moving forward beyond pandemic controls and concerns.
Yeah, and this is interesting. So it's their Costa cruises. It's only operating out of Italy. It's also a sneaky way against closed borders. We forget that South Africa borders to individuals. To certainly, there's a bit of business travel. There's some repatriation still happening in both directions, and then of course cargo. But holiday travel at our border posts is just shut down. And the same is true in much of the world. Europe, with their open border policy, there's some between countries happening. Although I note the cases in France is now their second wave is actually bigger than their first wave. But it is. Trying to get a sense of the reopening. What's it going to be like? I suspect something like the first cruise out of Italy is probably going to be more journalists than people actually on paying customers, etc. But sort of those signs of reopening, and then how does the reopening go? I mentioned a moment ago France. Their initial response to the peak of the pandemic back in March was a hard lockdown, not as hard as South Africa, but a hard lockdown nonetheless. They're unlikely to do that again. I don't see that governments have got the political expediency and power to re-implement hard lockdowns. They're going to have to get, to try some softer stuff, social distancing, mask wearing, maybe some sort of curfews and restrictions. But the leisure space is the one that's been hardest hit and really the one that's going to be coming back absolutely lost. If we talk about that K-shaped recovery, leisure is at the bottom of the bottom leg. And it's worth keeping an eye on what is opening and how the openings are going. How many tourists do they get on? Are there any cases on board? What happens in that regard? Trying to get a sense of how it will ultimately play out.
Yeah, definitely. And to your point about the lockdowns, I think there's been, a lot of concern. People keep on going, oh my goodness, we're going to go back to level 5, we're going to go back to level 4. And that's not going to happen. And, even with all the second waves, I think France is seeing a second wave, Germany is seeing a second wave, quite a few of the European countries. But definitely don't see a second or a hard lockdown. I think we just need to get accustomed to a new way of life. And I definitely think that might be something we see in South Africa as well, where we won't go back into that hard lockdown, but maybe we'll be a bit more stringent around the alcohol restrictions, or, certain things will just be, keeping curfews around, and requiring, permits to go to places, maybe closing up interprovincial travel, or things like that.
Yeah.
But I definitely don't see us going back into a very hard lockdown. I don't think anyone can afford that.
Yeah, agreed.
Going.
Yeah.
And then locally, and I suppose locally, but still somewhat internationally, Prosus now in Euro Stoxx 50. And, that I think is quite a great achievement for Prosus, and I suppose a South African firm.
Yeah, I mean it is a big deal, and I think it's a large part of why when Naspers was looking to try and unlock value in the holding structure, they looked at Europe as distinct from North America. North America, they wouldn't have been big enough for to really shift a needle. Prosus gone into the Euro Stoxx 50 as the biggest tech stock in that index. I think it's 21 economies that's made up of, dominated by France and Germany. No surprises there. The two big economies, certainly in the listed space in Europe, and it brings about 2 billion euros in, which in Europe is not a big number, but when we bring that home to South Africa, that's 35 or 40 odd billion in. Yeah, so that is significant. What surprised me was that actually, Prosus is actually coming under some pressure. Now that might be, we have been seeing some strength against the euro. That could certainly help. But this is part of the move by Naspers to try and unlock value. At points, the discount between the Tencent holding and the Naspers share price has been 40%, and therefore everything else is therefore valued, at zero, and then a 40% discount to the holding value. It truthfully, it's worked a bit, but not massively. I mean, they spun out multi-choice, that helped a bit. The cynic in me says if you really want to unlock that value, well, then spin out Tencent to Prosus shareholders. That will solve the problem absolutely, and that will obviously flow to those holding the individual shares, and then the 70% would flow to Naspers. But it's significant. I mean, and Tencent in of itself, I mean, we tend to forget. I mean, I think it's the second biggest company in China after Alibaba. It is absolutely giant. We tend to think of it as just WeChat. It's a lot more. It's got stakes in Epic Games. Heck, it's got a stake in Tesla. About, I think, a 5% stake in Tesla. So it is giant, and it is, it's kudos. It should have. I expected more positivity from the price action on Prosus. That hasn't materialized, but certainly it does mean, in essence, we can claim Prosus as one of ours going into the Stoxx 50. What it does mean as an interesting point for South Africans, however, is that if you are buying the Stoxx 50 ETF, which is the Signia SYGEU is the code, is that you're now once again doubling up on Prosus, because of course you get some Prosus and a lot of Naspers in your South Africa funds, both the sort of generic ETFs and Reg 28 funds, and now you're going to get a bunch of that also coming through, not the same level of concentration, but coming through as well from the European, and of course that Satrix China ETF, Tencent was about, if I recall correctly, about 14 or 15% in that as well. So you could think you have a diverse portfolio, but you could be very, very, very long of Tencent.
Yeah, so I think, thanks, Simon, for pointing that out. I think it also just makes you as an investor have to really just be more cognizant when you're looking at your trading or investing strategy, especially long term, and just paying attention to those exposures and what they actually mean in your personal portfolio.
Yeah.
Before you have a large chunk of tech stocks that you unintentionally hold. But moving on, tomorrow we've got local GDP numbers coming out, and we're expecting slightly better numbers, and I think we've got better quality data now
Hmm.
with lockdown lifted. I think, but still unlikely to look, particularly great.
Yeah, they're going to be a horror show. I mean, this is Q2. This was, Q2 started, 1st of April. I was checking earlier this morning. We were basically in hard lockdown all of April and all of May. I mean, May was level 4, but my memory, I can't remember what the difference was between level 5 and 4. I couldn't buy cigarettes, I couldn't buy drink, I couldn't go out. It was all just the same blurry type of scenario leading into winter. So the numbers are going to be horrible. For me, it's going to be, I suppose, how bad? How does that play into the full year? We still seem to be targeting around about an 8% GDP decline for the entire 2020. But then also Stats SA does great data, so we would be able to delve into it and see, which parts where. Now, even mining would have been hit because they were able to operate in some cases at 50% capacity, but they kept on closing down when they got positivity cases and the like. It's going to be, where were the areas that are hard hit, and from that, can we see some sort of improvement? Retail is going to be hard, but how's retail coming out on the other side? What are we seeing from other retail activity numbers that we are seeing? Because the GDP data is typically fairly late. I mean, this is end of June data, so it's about call it 9 weeks post the period end. We've seen retail, we've seen mining production numbers out since then for July and the like. We've seen PMI data most recently for August, which came out last Tuesday. So we're getting a sense of it. Some people are saying it's going to be as bad as 40% annualized. I'm not smart enough to make that call, but expect an absolute horror number out. And truthfully, as ugly as the number is, no surprises. Our economy was literally locked down for 2 of those 3 months.
Yep, definitely. And I think, like you said, brace ourselves for a really, really bad reading. But let's just hope that Q3 then looking forward will look a lot better. And I suppose it'll be interesting based off those numbers to see what impact that has on some of the decisions that need to be made by the Reserve Bank and so on. So lots to think about, lots to consider going forward around these numbers. I think they will be very key for us. But and then on results, so we had quite a few: Truist, Northam and Implats, Lipstar and AdTech, and I think there was quite a mixed set of results from all those companies. It is results season, so we're going to be seeing a lot of these streaming in, but pressure obviously around the retail environment, but Northam and Implats not quite so bad. AdTech, I think we've spoken about 2 or 3 weeks back, so nice to see those results coming through.
Yeah, I touched on it, as you say, we result season, and I picked on a couple where I had some commentary because there's just more results than truthfully we can talk to all of them. True is, I thought the numbers weren't bad. All things considered, I suppose in part it's because this was annual results to end June, so only 1 quarter of lockdown. Their office acquisition in the UK, frankly, remains a disaster. Their online activity shot up, I think it was 180%. And what interests me is how much will that stay. Michael Mark, CEO, commented that they've definitely seen 3 key trends. One is online. That makes sense, and I wonder how much that stays. 2, we're shopping a lot more resilience in the more sort of rural malls and the smaller shopping malls, and that makes sense. Firstly, I live in Joburg, so I can go to some of the biggest malls on the continent, but I'm not. I'm staying in my local little mall. It's it's sort of an outdoor mall. It's quite small. It's only about 15 or 20 shops in it, much smaller. Obviously, a lot of people during the lockdown returned to their sort of primary residences where their family are, which is more rural. And also a lot less, me and you are afforded the luxury living in a giant city to do online. in the rural environment, that simply often doesn't work. But I've seen that from a couple of folks. Even Fortress, who had results out late on Friday, commented that their rural malls are actually holding up fairly well. And that plays into Vakele, who I think's got probably the biggest concentration in that space. Northern and Implats, single commodity miners, when your commodity's running, knock it out the park. They've done well. Implats reinstating a good dividend. Northern instead buying back their Zambezi preference share, which pays prime plus 3.5%. So they're of the view that that's a better way to return cash. They've now bought back about, I think, 46 or 49% of that. Really interesting point. I spoke with the CEO of Northern last week, and we were talking rhodium, and the rhodium price has confused me. I don't know why it's been so resilient. And he said that in the wake of the VW scandal, if you remember their emission scandal where they were basically cheating the testing, regulators insisted that the amount of PGM used in a catalytic converter increase. And in the case of rhodium, it's gone from 0.3 to 0.45, which on the surface is not a heck of a lot, but it's a 50% increase. And that's rolling in between 2015 and 2025, which actually then starts to sort of underpin the demand for rhodium and make a little more sense into the price moves that we've been seeing from rhodium. That ETF from One Invest, Johan and his team, it's trading at almost, I've got to get my zeros right. I think that's 21,000, or is it 2,100? 2,100, not 21,000. For an ounce of rhodium. But it does suggest that there is fairly strong underpinning there. Lipstar numbers, I thought Lipstar weren't bad. And if we take them into account with AVI today, the AVI numbers came out early this morning before the market. AVI, their fishing really, really hurt. Shoes, that obviously struggled, but their snack brands did quite very well. And people are saying, well, comfort food, what else could you do in April and May? Stuck on your couch, Netflix and snacks. And I suppose so. And certainly the Lipstar numbers, the Lipstar numbers, certainly the food manufacturers have struggled, and there's some input costs with our maize price, much higher than we thought with the good yield we were having. Wandile Shalobo was commenting that we were on for a record year, and we are. But unfortunately, drought and locusts in other parts of the continent and East Africa, well north of us, although Zimbabwe as well, has seen global demand increase, and therefore sort of import parity pricing increasing as well. So I thought AVI weren't bad. I thought Lipstar numbers were actually quite good, and the market certainly liked them, pushed the stock higher. And then the last one was Advotech, which is, we always say, as you said, we've talked about it before. We spoke about Kuro and Stadio when their results came out. And the question was very much a case of, well, okay, parents will overspend for their child's education to get their child a better education than they had, as far as possible. There comes a point where simply you just can't. And we've seen the schools struggling. Immigration hasn't helped. Parents having to shop down. But of the three education stocks on our market, I thought Advotech was actually really good numbers, and the prices responded well. This is a stock that was down at 6 Rand in the sell-off again late May, and now trading up at 8.50 Rand and some change. Responded quite well. So we're seeing pockets of opportunity, and we spoke about that K-leg a moment ago when we were talking about markets more generally and tech versus the rest. And I think as investors, and I know when things started to happen, I know in March and April, and I said in as many words on this podcast, I said, I am just buying my ETFs. I am not buying equities because we simply don't know how this plays out. And now we're starting to get some pictures, and we're starting to see some of the stocks that perhaps these are actually really attractive valuations. And we don't have to jump in. We don't have to go in boots and all. But certainly, I would Advotech would certainly be, for me, one of those on the list. AVI would be another. AVI is by head and shoulders my preferred food producer against Rhodes, Lipstar, Tiger, Pioneer, etc., etc. AVI price still struggling. But it's time now to start, poking around and seeing, maybe there are some stocks that, as you said earlier, they're not going to go bankrupt. 2020 is going to be a horror year for them. 2021 is going to be a tough year. But if we look to maybe 2022 earnings at current prices for those stocks, there's some value out there in our market.
Yep, definitely. And now moving on to a very interesting topic at the moment. Spur's CEO leaving, obviously, after
Spur.
quite a long stint there, but the COO following, and I think he probably was looking to, be taking over that CEO position, but didn't quite happen. And so we're seeing quite a large exodus of, leadership at Spur.
Yeah.
What could have spurred this? And I think perhaps should investors be concerned about a leadership crisis?
So Spur, not Spar. It's hard to tell. So Pete Fontonda leaving as CEO, he's been there forever. He actually joined 1982 as a restaurant manager. So he's served his time and is moving on and gave 6 months of notice. I think your comment around the COO is probably right. They haven't officially announced a replacement yet, but maybe he was passed over for it. He has the master franchise license for Spur in New Zealand and has a Spur in New Zealand, so it looks like he's immigrating to New Zealand. He basically left effectively immediately, and it's often interesting where CEOs or where potential candidates for the CEO rather are passed over, and there's different ways of managing that. Sometimes you do dual CEOs, and sometimes it's just one man or woman gets the job and the rest of you sorry, and truthfully most often it's the CFO who gets it, not the COO. There are exceptions, but mostly it's the CFO. But then what we also saw, which I thought was quite interesting, was 2 non-execs who were leaving. Now again, lots of reasons, etc. But certainly, suddenly come January 1st, that's going to be a boardroom which has lost plus 50 years of institutional knowledge and experience. And that is not insignificant. It's not necessarily a crisis, and I'm not saying that Spur is necessarily going bankrupt, but it certainly is a significant loss of knowledge around the sector, around the business in particular, and the like. And that is that can hurt a business in the short term. They'll catch it up again. Spur's quite uniquely positioned as a family dining restaurant. In the US, there are a number of chains with literally tens of thousands of stores. In South Africa, there's maybe we could throw Wimpy in there. I'm not sure really, but Spur's kind of cornered to a fair degree that family dining establishment, and I think 2020 has obviously been really tough for them, but 4 changes at their board level. I think 2021 is going to be a slower recovery than perhaps we would have liked for, as they lose that institutional knowledge.
Yep, definitely. And lastly, Simon, I think let's just move on to ICASA. So again, Spectrum auction being delayed. This has been an ongoing issue, and for a very, very long while. I forget her name, but former communications, the late comms minister. Oh, I cannot for the life of me recall her name, but this has been an issue that's been ongoing for years. What exactly is going on with the Spectrum auction?
And I can't remember her name. And there truthfully have been so many ministers in that space. And at one point under President Zuma, he actually split the portfolio. So there's just been delays. I mean, the one example, we were supposed to have moved as a region. SADC was supposed to move on to digital TV. I think July 2015 was the deadline. Much of SADC has moved. And when I say much of SADC, because South Africa has not. We have been testing and it works. We need to get the set-top boxes and the like, but we are 5 years late on that. And this digital spectrum in particular, it was one of the president when he announced the pandemic package, the 500 billion package, which at the time, as we pointed out, wasn't all hard money, but be that as it may. Part of it was to quickly release the spectrum, and it simply isn't happening quickly. Now moved to probably March of next year. And the reason why it's so critically important, and the telcos are all gearing up for it, Telkom, Vodacom, MTN, and all the, Dark Fiber Africa and everybody else also wants in on it. What's important of it is that simply we need the spectrum as a country, because we're running out. We still got networks running on 2G spectrum, which we can't shut down, because there's a lot of it's been used by Internet of Things devices. You can try and repurpose, but you've got to be careful. So the telcos are currently supporting 2, 3, and 4G. They're obviously moving into 5G. And they need more spectrum, and the government needs to free it up. Now, the digital, moving TV onto digital, that will free up a large amount, because at the moment there's the big bands for TV and radio, because it's analog. As soon as it's digital, you narrow that band down, and you've got the space between the bands that you can then on-sell for the telcos. But they need that spectrum, and they've all the telcos have said, look, partly they've said the reason we have high data prices is because of the lack of spectrum. Yeah, I think the reason we have high data prices is because they can. That's a different story entirely. But certainly, it would enable us to get, more capacity, more speed, and maybe better prices. So it is critical. And unfortunately, as I said, the president had said he'd hoped to do it in Q3 of this year, and now it looks like it's pushed out to the end of Q1 next year. So another 6-month delay.
Yep, and another 6 months delay, but still with the likelihood of yet another delay, if the past is anything to go by. So definitely something to watch. Yeah. Definitely something to watch for us. And then lastly, to sign off, because we're done, the US is running out of quarters. That's particularly surprising. I have a nice stash of their coins if they'd like some. But they have those laundromats where you can go in, slot in a quarter or two to get your washing done, and they are running out of money for those.
Yeah, it's actually quite astounding. So, particularly laundromats, but casinos, those machines you get a Coke out of, vending machines, etc., etc. And apparently it's partly because people went emptying the machines during hard lockdown. People aren't going out and sort of circulating the quarters. And I mean, the article I was reading about this, I mean, people are literally traveling across state into other states to buy truckloads of quarters. The Federal Reserve, who obviously mints them, also pulled back during lockdown, which has created a bit of a logjam. But I mean, it's quite astounding that, what's a quarter? 25 cents. Okay, I mean, that's $4 in our money. I mean, it's not nothing. But suddenly they are literally just running out of quarters, and those machines are all just set up to take them, and suddenly not enough.
Yeah, and I suppose it'll be interesting to see how they innovate around that. Do we introduce card payments for laundromat things? I think we've certainly seen a lot of vending machines that are becoming allowing card machines. I know at Standard Bank in the headquarters it's completely cashless. So it could be quite a nice way to sort of digitize that entire value chain.
Yeah, quarters are very last century. That is a great point.
Yeah, but I mean, America still has checks, so maybe let's
not get too excited.
But yeah, Simon, thank you very much for yet another session, and thank you to everyone